Asia may be entering a new era of climate volatility, with stronger typhoons, more frequent floods, and potentially more heat waves. Traditional insurance models built for a more predictable weather world may struggle to keep pace. Meanwhile, super apps now reach hundreds of millions of people daily, so the mechanism for delivering and distributing real-time protection and real-time information is no longer theoretical. It's potentially becoming inevitable. And this episode of the Asia Tech Podcast wants to know, how does insurance need to change in a world where climate risks seem to be intensifying? What is necessary for parametric and climate insurance to scale across Asia? And can super apps become the most significant distribution and engagement channel? We'll see how those things matter for climate resilience across the region. Friends of the show, Shwetank Verma, a co-founder and managing partner at Leo Capital, and Bernhard Kotanko, a senior partner and Asia-Pacific insurance practice leader at McKinsey, join ATP again to address some of these questions and more. Gentlemen, welcome back to the show. How are you both doing today?
Very well. Thank you, Michael. Great to see you, Shwetank, and happy Friday to everybody.
Happy Friday to everybody indeed. Okay.
Thank you, Michael. As always, great to see you, Bernhard. Thanks for having us here.
Thank you, guys. Okay, let's just do the one big question right now. If climate risks are increasing across Asia, how fundamentally do you believe insurance needs to change, not just in product design, although we can address that as well, but in how protection is delivered and experienced? Shwetank, why don't we start with you, and then we'll go to Bernhard.
Yeah, I think, Asia has one of the largest populations of new to insurance customers. So these are people who have never experienced insurance before, but yet insurance itself has not adapted. We continue to have the same clunky claims forms, complicated products, hard to comprehend the risks that are being covered, and just asking far too much of the customer. The bottom line is insurance is still stuck in the old analog world where you had to extract information rather than the new digital world where you can just tap into information. So the opportunity exists for a root and branch rethink of how do you offer protection to more than 1 billion people who are new to insurance. But I'm not sure anyone is really grasping that bull by the horns at the moment.
Bernhard, what do you think?
So I want to start by anchoring us in a few numbers. So the total economic loss from natural disasters has reached more than 300 billion globally in 2024. The insured losses are roughly 140 billion USD. So we roughly have about a 1/3 coverage by insurance, 2/3 is the protection gap. This protection gap is significant and is gradually widening. But equally, the insurance cover for NatCat is also increasing. One thing we should say is when we look at the share of NatCat losses relative to GDP, interestingly, it's relatively stable on an inflation-adjusted basis. I was surprised looking at this and preparing for our discussion today. The fact is, though, that is because a lot of GDP contribution comes now from intangibles, and of course, intangibles are less affected by NatCat. I think it is widely recognized, at least outside of certain circles, that climate change is a driver of the increasing NatCat risk and the increasing NatCat losses. I would quote Munich Re research. Swiss Re has done similar, other reinsurers, the Geneva Association. So there's wide research that there is a assumed correlation between climate risk driving these losses, and it is a significant underinsurance. So that's, I think, important to anchor us in these facts. Now, when it comes to the use of technology, the question is who is the buyer for NatCat and who is bearing those losses? I think it's very important that, of course, a lot of the NatCat covers, end of the day, end up on the national balance sheet. So it's essentially the taxpayer through government spending that is taking a good chunk of these losses, plus a lot is then in corporate and individual asset holders. So the houses that burn away or are basically damaged by flooding, et cetera, et cetera. And to your question, where would now technology help? I think technology helps, of course, in data and digital and advanced analytics and AI help a lot in better forecasting and probably also faster warning and better better prevention mechanisms against these risks. I think there is a need for an insurance literacy and a Nat Cat literacy on what can you do and how can you prevent and how can you at least then also minimize the damages. I think this is where any form of technology can help engage. To Shwetank's point, I think this is where we can go from the analog to the digital, but we shouldn't forget a lot of the bearers of the risk are in the end public households, and we need to think about how do we make sure that all participants in society really take responsibility for minimizing and mitigating that risk.
So can I just ask you one question, just so the listeners and the viewers can understand? You said a growing percentage of GDP is in intangibles. Maybe you can just explain what that means, and then I have a follow-up on some of the other stuff that you've mentioned, because I think it's kind of interesting, actually.
Sure. Essentially, models, large language models, intangibles, brand value, royalties, all these are intangibles that contribute to the measurement of GDP. And of course, when we look at economic losses from natural catastrophes as a percentage of GDP, a wildfire, as tragic as it is, it doesn't change the value in the GDP of these intangibles. And I just wanted to calibrate, because some people say, well, Nat Cat is stable relative to GDP, and therefore, is it really getting worse and worse? And I would argue, yes, it is getting worse and worse. It's just because of the composition of GDP is evolving. We see that ratio not dramatically changing. But of course, the economic losses are significantly growing. I mean, the number of severe events in the US, for example, has tripled, if I'm correct, over the last decade. And we see significant, in between 20 and 30 events of significant wildfires, extreme heat, flooding, hurricanes. So we clearly see an increase in frequency and severity of these events.
Yeah, I mean, last year in California alone, the wildfires were bigger than they'd ever
Exactly.
been before, right?
Exactly.
And I think I did some research as well. If you go back,
And insurance.
Go ahead.
Insurance has stopped covering bunches of zip codes, right, in the US, so you can't get cover for any price for a bunch of Nat Cat risks.
Yeah, so particularly in Florida, in California, there are a lot of places where there's not being coverage, and I think part of the reason why is like whether it's because humans are changing the climate or whether the climate's changing on its own. In a way, I don't really care, but you can't argue with the fact that the storms are getting bigger, the wildfires are getting harsher, and that the damage is getting bigger. I mean, whole swaths of like California around Los Angeles just like disappeared. And in this particular case, if I remember correctly, these were really expensive neighborhoods as well. So the value was super high.
No, just as a fact, if I'm correct here, the Palisades wildfires, the damage was 40 billion in itself. So that it was the biggest, I think, single damage.
Yeah. And somewhere I read, and I don't know the exact number, Shwetank, I'll let you talk again in a second, that the amount of like land and buildings that get burned has gone up by like 3,000 or some huge number between like 1975 and 2025. And it's just like incrementally getting bigger and bigger every year. So it's not like it's been immediate. It's just been gradual, but year by year. Sorry, Shwetank, I interrupted you.
No, I was just saying that one of our portfolio companies, an MGA in the US, which underwrites flood risk, called Broadly Graph. Basically, the models which say the floods are 1 in 30 years are basically happening once in 10 years. That's the change in the intensity and severity of the floods.
Yeah, and to be fair, like I was asking somebody, it's December here. The weather in Thailand is amazing, as you guys know. Sorry, not bragging, just reporting. But I was asking one of my Thai friends, like, where should I go on vacation? And the natural answer is normally just go down south, where like the islands are beautiful, the weather's normally great. But this year, the floods have been insane. Like really, really large. And if you see the pictures of it, it's literally like, I don't know, meters up on a building and cars floating all over the place. So that's not good either. I want to talk about this data and advanced analytics and faster warning, right? So there's some question in my mind, and I'd love to know what you guys think about this, is will insurance companies actually take up some of the slack and say, we're not just going to underwrite stuff, we're not just going to make payouts, but we're going to build our own analytics, or at least partner with people that have analytics so we can get a better understanding of future risks as well, and then try to work together as a service to help people that may be at risk to build in more resilience and build in more protections and build in more warning signals.
We've seen it in different parts of insurance already, like Vitality and Discovery on the health side, Luco and a couple of others trying it on the home insurance side. And again, I think in our portfolio, we see a bunch of companies attempting to make smaller things like raise your foundation if you're in a floodplain, or do smaller things that significantly change the amount of damage you incur if an adverse event happens. I have to say, at the moment, I don't think the insurance industry is leaning into this, at least on the ground up, the bottom up. Yeah, the prevention model, the service and prevention model. At best, it's token efforts. Again, I'm talking from my experience in our portfolio companies. I'm sure there might be some insurers that are doing a much better job, but it seems to be more like a tick the box kind of exercise rather than truly going prevention first or thinking how to sort of rework their workflow around that. But in the long run, I think it's a great way to stand out, and I think you'll see a lot more maybe startup insurers, especially startup MGAs, winning market share by providing more of a complete package rather than just making you financially whole for a adverse event that you've suffered.
I'd be a bit more generous with the insurance sector, if I may say. I think actually many insurers are investing in an active service provision to policyholders. There is all sorts of extreme weather warnings that you get by insurers. There is the attempt to offer prevention. But if I'm trying to be systematic on where they can intervene, I think the first one is to use analytics to understand the risk better and therefore price adequately. And rather than, Shwetank, what you said is rather than simply say we don't insure, to find ways and conditions and also prices to in the gray zone between the insurable and the uninsurable, to try to also contribute to society by holding the back and saying, okay, we can insure these things under certain conditions, maybe with a public backstop where the government steps in on some extremes, outliers, etc. But that is, I think, one important aspect. That is, of course, especially the reinsurers investing heavily in advancing their models, in updating regularly, but equally the primary carriers. But we need to say that a lot of the nat cat risks, of course, end up in the balance sheets of the reinsurers. The second point is then, how do you create awareness? I think awareness is step one. Then it is prevention, and then it is just protection in the case of damage. And I think that it is important to really help people understand how to prevent the damages. Now, nobody can prevent the flood, but what kind of mechanisms do we have in communities, in risk areas, to limit the damages, whether it's through dams, through all kinds of protection infrastructure. Secondly, then, how can we make sure we understand on some of it how we individually can protect ourselves? Something basic, what you do in extreme heat. How can you protect by, as simple as just making sure you drink enough water to avoid the spikes in strokes and in other heat-related deaths. And then lastly, of course, it is the direct emergency support, where it is around just trying to save lives. And then the fourth one is in the recovery phase, how can you use technology and smart data to help accelerate the logistics and processes of recovery? But I think it's not a natural one. Unfortunately, I don't see that technology will be the silver bullet on these things. I think this is a mega trend where nature is forcing humanity to pay the price for causing climate change. And we can at the margin optimize, but I think it is in general, it's unfortunately a difficult situation that will not go away.
I think there's a really interesting point here about prevention for insurers. So again, going back to the MGA we have doing flood insurance, they identified that if this homeowner invests in sort of raising their foundation, the chances of significant damage go down by like say 40%. But the cost of that, the insurer is not ready to bear it, right? It's a go get a loan and make that happen. But if it house floods, they will pay the full price of the house. So I thought it was a really fascinating sort of issue here that because the cost is upfront, you're not willing to find a interesting solution around it, but you're happy to take the premium and then pay the entire sort of proceeds if a bad event happens.
So one of the things that I think Bernhard said at the beginning, if I understood it correctly, was that a lot of the risk, or at least the risk payout, ends up with governments, whether that's in the United States or across the world, right? Did I get that right? So if that is the case, do we see situations where there'll be this sort of public-private partnership thing between governments and insurers where somehow they do figure out how to build in resilience, where there are like maybe tax benefits of, like you said, raising the platform, so the insurers don't have to bear the cost, or the cost is split between the homeowner, the insurer, and the government itself, because all of those people benefit. I mean, one of the things I was thinking when you guys were talking earlier is, Shwetank was contending that it's just kind of a checkbox thing, and they're just kind of giving it like a little word of mouth to say that they want things to be more resilient. And Bernhard kind of didn't agree with that. But the point I was trying to make is, doesn't it benefit the insurers as well over time? And I think, Shwetank, that's exactly what you're suggesting is, why not invest in it today so you don't have to make the bigger full payout later? Like, doesn't it benefit the insurers anyway at some level?
So I would say that there are multiple public-private partnerships to mitigate NatCat risks and also create risk mitigation through insurance, whether it's insurance-linked securities, whether it's NatCat bonds, whether it's countries that essentially take out NatCat insurance. And then, of course, there are all the cat pools. If I take just as an example, the Caribbean Cat Risk Insurance Facility, there are areas where governments, even cross-country, come together and work together. So I think that is clear. There's also sovereign risk transfer, where essentially states take out insurance covers. And I think that we will see more because it is a systemic risk, and it's very hard to insure the individual one. And such a systemic risk is hard for any individual insurance company to take, which is why they retrench. And that's where it will require more of these public-private partnerships, which then also allow the kind of prevention mechanisms that you describe.
No, I think agree with Bernard's points here. There's, especially in the global south, I think some interesting public-private partnerships. Interesting in the United States, the government is retrenching, actually, shutting down a lot of like the flood program is shutting down more or less and getting completely privatized. But overall, especially if you're to talk about Asia, you have to have a public-private partnership to get this right.
You almost have to, yeah. So how are climate risks reshaping the economics of insurance in Asia in particular? And we kind of talked about this maybe before we started recording, but are parametric models, like, where are they suited for in this region, and how do they participate in what's happening right now in the insurance industry when it relates to climate risks?
What we do see is a rapid, of course, advancement of modeling the impact of climate change, and therefore the forecasting of NatCat risks. I think for insurers, it's a double-edged, of course, because there's one aspect is to assess and estimate and model the risk exposure, but there is also one to further assess the resilience of the potentially affected assets, and therefore estimate the damages, and even starting by assessing and properly adequately measuring the asset values. So if I take Shwetank's example of the house, how do we properly make sure we are clear about what this house is, how strong it would withstand certain damages or certain risks? Is it properly documented? And therefore, is it actually insurable? And I think we need to see both models. There's one model, which is how do we properly assess and anticipate insurance risks, and therefore understand frequency and severity of what happens. But then we also need the other side of the equation and say, okay, if that's happening in the southern Thai islands that you described, Michael, or that in the wildfires and with heat, etc., then what are really the asset values, and how well are they prepared to weather the storms or weather the impact? I mean, I take earthquake. In some countries, we actually see that the infrastructure is extremely resilient to earthquakes.
In Japan, in particular,
And
it's
that's
super. It's
in
super
Japan in
resilient.
particular. Japan is the classic example, exactly. And that is very important to recognize. And how do you then put both sides of the equation together? And this is, I think, where insurance can really be a forcing mechanism to say, for at least some risk exposures. Earthquake, I think, is a classic to say, how do we make sure we have enough prevention and protection against the damages? We cannot prevent the earthquake, but we can at least minimize the impact by preparing the assets.
Yeah, I mean, Shwetank, you'll appreciate this, right? I bought some land and built a house in Tokyo in 2006 and 2007. And then in 2011, there was like one of the largest earthquakes in the world, which happened while I was at work. My wife was at a meeting outside the house, and my daughter, I think, was at home. I think she was. It was the only day of school that she was sick, if I remember correctly. And the maid was there with her. It scared me terribly. The building that I was in was 20-something years old at work, and it was shaking like crazy. And literally, like the plaster from the walls in the stairwell were popping off as we were literally running out of the building. And I was just wondering, like, what kind of destruction I was going to run into when I got home, and was my daughter okay? But when I got home, since the house was brand new, like not even a plate moved in the cabinets. And the only reason why I'm saying this is that you can build resilience into these things the same way if you build your foundation higher, you're 40% less likely to have total damage. And Japan is the perfect example of this, so we think this should make you happy. Where you're living is probably super safe, even if there's a gigantic earthquake. And I will say this, in April of 2025, in Bangkok, there was an earthquake. Luckily, again, I was in Singapore at the time. But the damage in my room here was worse than the damage in my house in Japan, because of the level of resilience necessary just to build a building in Japan is different than it is in Thailand. Does that make sense? So it's possible to do these things, I think, at scale. Sorry, go ahead.
And this, Michael, is where insurance can have a forcing mechanism to say we are insuring, but that is the conditions. And I think that's happening. Could it be done more? I would say yes. Should it be done also for other risks? I think the big two where we should discuss is flood and fire. I think flood and fire would be, for me, the logical ones, where, again, what can you do to minimize the risks in zones where you know these are exposed to either of the two?
You mentioned something about insurance being a forcing function. That's really important to keep in mind. My friend Dan White calls insurance the apex predator, because by setting reimbursement standards, right, you shape behavior, you force behavior across all lines of business, and specifically the opportunity to do very interesting things in Nat Cat around what's happened in Tokyo, right? You can't now get, or Japan, you can't get insurance unless building codes are of a certain standard, the construction is a certain standard. So that is a huge opportunity as you think about climate resilience across Asia.
Yeah, and I'll tell you guys another story, which you'll find super interesting. I think, like I said, the building that I was in when the earthquake happened was 20-something years old, and some of my friends were in Roppongi Hills, which was essentially a building that was like 3 or 4 years old. They'd forced us out of my building, okay? Like the building forced us out, but they made them stay in Roppongi Hills because it was safer for them to be inside that building than it was for them to go outside, because the danger, and again, a little bit off the insurance topic, but the danger in being outside of a building that potentially could have structural damage is the glass creates like shrapnel if it breaks. So we were actually more at risk. But the new buildings, as you said, because of the code was there, and with insurance as the accelerator for this, they were safer inside the building than they were outside the building, which I thought was kind of interesting. Yeah. So I brought up this idea of parametric insurance. I'm just wondering where this fits into all of this. Sometimes it's brought up as like this simplification of a model, but it seems like it's been harder to scale out here. What are some of the challenges that's making it hard to scale? And do we end up with sort of para indemnity as opposed to pure parametric insurance? What does that look like to you guys, particularly when it comes to climate risk?
Yeah, parametric insurance is one of those things which is its big year is this year. I mean, that's been like 20 years. This has been the year for parametric insurance
Right.
to
I feel like
be
I feel like it's kind of like Linux on the desktop. It's like it's definitely
yeah,
coming.
that's a great analogy. Again, I think some great progress has been done. Some very good products have been made. The fundamental challenge, I think, still remains this data availability in oracles to truly be able to accurately gauge the amount of damage done. So what you ended up with very simple triggers and simple covers, which either don't do enough or do too much and are too expensive. And getting it right to the actual level of damage at a small farm holder or something has proved to be quite complex. I do think data availability now with satellite imaging, AI, etc., there is an inflection point here. And I think we're seeing, again, from the venture world, we're seeing some very interesting new founders coming up with, parametric first models, far more sophisticated than the earlier simple triggers and simple payout models. So it's an exciting, and again, it's this time is different, is always risky things to say, but I do hope this time is different for parametric because it solves the key pain point in Asia at least, right? That the customer does not need to file a claim. It's a magical claim experience, and that is transformative. That truly transforms how insurance will be perceived and how insurance will be consumed. So I'm rooting for it, but the data issues and getting the product complexity right remain significant challenges.
So I would be very bullish on parametric insurance. And just, I think there's, to again anchor us in a bit of data, the global parametric insurance market is only at about, I think, 16 billion US dollars in 2024. It's growing at about 12, 13%, which is, depending on what numbers you use, between 2 and 3x of global insurance market growth. So it is clearly gaining in relevance. And of course, as Shwetank said, the sophistication of triggers, because what is the big benefit? The big benefit is an objective measurement, whether it's wind speed or whether it's other metrics that you use, rainfall levels. That is a very objective measure, and it leads to a very rapid payout and rapid response, which of course, in the case of a catastrophe, is the big advantage because it allows just to avoid the very lengthy processes of loss adjustment in an indemnity cover. What I'm sometimes wondering is, it just also, it simplifies the whole journey. I'm not sure whether it then really helps to solve the problem because you still need to define how big is the payout and at what trigger. So if we take, rainfall levels, okay, fine, let's take rainfall levels. That's easy to measure. But what is the right rainfall level for me as a customer? No matter whether I'm, in a community and I'm the mayor of a town and I discuss this with the insurer, or I'm a corporate, or I'm a government official and I think of it. So what is the level of rain that is the right trigger and how much money? And for that, I still need to think a lot about what I said earlier. What is the likely damage to assets under what kind of natural event? So I think we shouldn't oversimplify it to say, oh, wonderful, we just define a trigger. It's a fixed payout, all very easy, because those two numbers, the trigger and the payout, become actually very complicated to define.
I was going to say that's where the objectivity leaves and the subjectivity comes in, right? So you're trying to build this new product, whereas objectively, like it's rained 10 inches or whatever, 25 centimeters, like whatever it is, right? And that's fair and that's easy to measure. But before you do that, you have to write a policy that says, well, what's the subjective value of your house? Or if your business is closed for 7 days, what's the subjective value of how much business you're going to lose? So you're just, in a way, you're just kind of moving the problem from valuing this thing from an indemnity standpoint to, okay, now we have a trigger that we understand, but what's the value that I have to protect? Because now we have to kind of concern ourselves with that. And I want to, sorry, did you want to say something?
No, I give you an example. I live in Hong Kong. Hong Kong, we have every year almost every year, events of what we call here black rain. That amount of black rain in many other cities would lead to severe destruction. Hong Kong is very well prepared for this. Really, kudos to everybody in the city. It has very good protection systems. So while the streets may be flooded for a day or two max, it's very quickly resolved, and the damages compared to the amount of water is actually very limited. So again, in a parametric insurance, you need to take all these things into consideration, because an amount of rain which constitutes a black rain in other cities, I don't know, Bangkok, I speculate, I don't know the details of the Bangkok flood risk management and prevention, it would be severe damages, while in Hong Kong, the city has been used to doing this for decades, and the city is actually reasonably well prepared. I don't want to diminish it, but it's just, I think the dynamics, you need to think through all these elements, no matter whether you go with parametric with simple triggers or you go into a full indemnity. It doesn't solve the complexity of the issue.
I'm curious if you know what the government or what society itself has done to make Hong Kong more prepared. I lived in Hong Kong for a very short period of time, 5 or 6 months. I can't remember the exact number, but I've been to Hong Kong like 1,000 times. So there are mountains, there are deep valleys, right? Like where the racetrack is, right? Which probably flood more than the peak floods. But like, what have they done to disintermediate the damage that could be caused by the black rain, if you know what it is? Like, is it better drainage? Is it other things?
I think, of course, it's grown over a long time. So first of all, I would say that the drainage system is excellent. I heard that it really is prepared to have that ability. Then second, of course, Hong Kong is blessed with a lot of nature, and blessed also with a lot of water around, where you can quickly essentially link the drainage to just getting rid of the water into the sea very quickly. I think that is all very good. Then, of course, the protection system with the Hong Kong Observatory is very good, and therefore early warning systems and all this is very good. And the public is used to it. I mean, when I came to Hong Kong in 2014, 15, we were shocked by the first, experiences of that such heavy rain. But you learn how to deal with it, and I think that is where it is one of the strengths and of resilience in this city. But what it means is other cities are not prepared as such. And back to insurance, the complexity for an insurer as well as for the customer to think about these dynamics doesn't go away, no matter whether it's parametric insurance or a full indemnity cover.
Yeah. So Shwetank, you mentioned earlier this idea of like, parametric, and I've been talking to people that are actually building parametric products for the last like 5 or 6 years. And then of course there's the original, maybe not the original, but parametrics itself has been around for a while. And you're right, like the triggers were simple. And you said one of the biggest things was like data. Are there new types of data? Because you said maybe we're getting closer. Maybe this is the year of Linux on the desktop, if you don't mind me saying. I just find that so funny because I was involved in that for the longest time. But are there new types of data, whether it's satellite was one of the things you mentioned, that makes use cases that previously were impossible, possible, from your perspective?
Yeah, Linux on the desktop is a customer behavior change problem,
So go for
which
it.
is a much
Yeah,
much harder problem to
no,
solve
it's a
than
different problem for sure. It just makes me laugh.
technical data pipes problem. Look, I think what's changing is both the availability of data and our ability to sort of extract value from it. So, fidelity of satellite images, improvement of uh, even simple things like Google Street View, etc., has all sort of grown exponentially over the last decade or so. And the ability to use alternative data to actually assess the damage has also increased. So I think cutting edge models these days are able to truly understand at a very atomic level what is the damage to this parcel of land or to this section of the building, and hence build up the cost, the sort of parametric product much better. So the change has gone from simple trigger and a very low payout just so that it goes back to Bernard's point, right? We could measure rainfall, but we couldn't measure that you are a farmer and hence the loss to you is much more than you as a simple person who sort of just a person who didn't enjoy or got sort of a little bit of flooding or whatever. So somebody destroyed their livelihood, somebody just had a little damage, but original parametric payout would be the same for both of them. Now you can actually say that this guy's a farmer, he's lost his livelihood, the payout needs to be this much higher versus, and it again continues to be automatic, it does not require a loss adjuster visiting, etc. So it is more data, but it's also more the ability to interpret the data in a much more granular and exact fashion.
Guys, one more thing and then I'll let you go. I mentioned in my intro about super apps. I know this is not insurance related specifically, but I'm curious how you think about this from sort of a payment, commerce. Like, where does this fit into not just customer engagement, but customer interactions when it comes to the insurance industry? Are there use cases here where there are so many people sitting on super apps that insurers can build bridges to them or use it in a way that maybe they hadn't been able to do before, and then can increase protection and can increase engagement?
One of our portfolio companies, Cover Genius, has built a fairly large global business around enabling the large super apps to embed the right kind of insurance at the point of purchase or at the point of deepest need. So, embedded insurance, this is effectively embedded insurance, and embedding insurance in the digital screen that most people use all the time is obviously the right answer. But getting it right and using the data that these new platforms put out, tailoring the product to each individual, these are hard things. But when you get them right, it leads to very large businesses like Cover Genius.
I would say this, of course, goes far beyond the discussion of climate risk and NatCat. I would say, of course, yes. Insurance, what I like about insurance, if it's done well, the purpose of insurance is it touches humans' biggest emotions, and it tries to turn these emotions, whether it's our fears, our dreams, the fear of a flood, the dream of a good retirement, the feeling of having peace of mind because our children are well protected in case a catastrophe happens, the feeling that we don't need to be worried about our medical bills. All of that are deep emotions. And then insurance tries to create formulas around it and essentially put a price on giving that stability and that security and that safety net. Strangely, and I'm sometimes almost angry about this serving in insurance companies, insurers struggle in touching that emotion. They're too technical. Shwetank, all the things you said, too bureaucratic, too technical. I recently bought a very simple P&C insurance, and now, I've been dealing with insurance more than 20 years in my professional life, so at least without being presumptuous, I would hope I understand a little bit about it.
Right, exactly. I've been doing this for a while.
I struggled with it.
Yeah.
Is this included, not included? You try to interpret these terms, and I'm like, gosh, this is hard. And so how do we make it easier? And this is now this is a long answer, so much longer than Shwetank's yes. But mine is also a yes, where, of course, the super apps can be a form of engaging because we need to build that. I would almost say we need to build within insurers emotional literacy rather than building insurance literacy among customers. Because I think insurers need to speak the language of the customers and not customers speak the speak the language of the insurer. And there, I think super apps can be a forcing mechanism because, of course, it's high frequency interaction. You can personalize, you can tailor, you can have all events and all networks, and Shwetank's portfolio company is certainly perfect for that. But it's the key is to begin to speak the language of the customer, that when you or I or anybody out there thinks about, okay, I'm concerned about what happens if I need medical support? What happens if I travel and the flight gets canceled? And that shouldn't be 3 pages of terms and conditions, but insurance should have the courage to say in plain English or plain whatever language, this is insured, this is not insured, these are the conditions, take it. And I think insurers are insecure in many cases, and therefore they hide behind this language. And this is where I like super apps or digital engagement, because it forces insurers to actually speak the language of their customers more.
I want to ask you, I know I said I'd give you the last word, but you've just reminded me of something. So I want to ask both of you one more thing. I almost never call anybody anymore. But I remember when I got my first mobile phone, was constantly calling people. It was a ton of fun. I never really SMS'd because I wasn't in a location where SMSing was easy, because the phones in Japan made it hard because of just the language thing, right? It was just hard. But now it doesn't matter if my friends are 50 years old or, 25 years old, constantly texting. But I must imagine that people inside insurers are doing the same thing. And again, whether they're 50-something years old or 25 years old, they're also constantly texting to their friends and family. Do you think it changes the way they think about how they engage with their clients as well? Like, I'll tell you something. My insurer, and I won't say who it is texting me pretty frequently. I wish they would text me in English.
Yeah.
Because they're texting me in Thai, which is very frustrating for me because I don't understand it. But they're at least trying to get some messages across to me in a way that make me feel like I'm involved. Do you think that there's this generational change that they are going to start to understand in the same way that you suggest that they should, just because it's the way they live every other part of their lives?
Yeah. 100% yes. And what we see is we work a lot with our clients on this without doing too much marketing for McKinsey, but we have whole practices to work on this, and the feedback is very positive. If you hit it right, and if you get the personalization right, that you know that Michael is somebody who we better speak to in English, actually the feedback is very good, because end of the day, we are all touched by these emotions. I'm a father of 3 daughters. Of course, I wonder, are they well covered? I'm at an age where I begin to think about my retirement. Is it, I know I have no longevity risk cover, so I need to save enough because I'm not in a system where I have a lifelong annuity. Should I get that privately? Yes, no. And for these things, I think the ongoing engagement through any form of social media and text connection is actually very powerful. And we see surprisingly high conversion rates and response rates and click-through rates from insurers that do it well.
Yeah, I like it. I get texts from restaurants, which I hate. It annoys me. But when I get texts from my insurer, it actually makes me happy. Sorry, Shwetank, did you want to add something?
Yeah, I mean, fully agree. I think we're seeing this improved communication across industries. So, from insurers, from banks, debt collection, getting communication right on debt collection changes collection rates dramatically. So applying artificial intelligence to personalizing communication and making it in modes that people like to receive it is a huge opportunity. It's a pretty low-lying opportunity as well, and insurers are doing a good job with it. So I'm happy for that.
Okay, I will let you guys go. Shwetank Verma, Bernhard, Kotanko, thank you both as always for coming on the show. I don't know how long that was, but that was awesome. It was really, really great. Thank you as always for your time.